Amy, when I think about the stories, that Charles Dickens wrote in the Victorian era, what was that, 200 years ago now?
I don't know, Holland. Don't ask me.
Long time ago. But there always seemed to be this unsavory money lender. And there was a reason for that. When Dickens was 12 years old, his father's debts finally caught up with him, and he was sent to debtor's prison. So as the sole breadwinner for the family, Charles Dickens knew firsthand what debt could do to a family. It was a traumatic experience, apparently, because he wrote extensively about the hardship that occurs when lending and debt go awry.
Yeah. And, Holland, unfortunately, times have not changed. I don't feel like we've learned many lessons from Charles Dickens.
Right.
Because at this point, everybody in our listening audience, everyone in the world will need at some point to ask for money. It is very few people who ever can just skip through life without coming to some kind of debt, whether it's from a parent, a friend, a bank. And most of us cannot take on these big purchases and need that extra money to start up a business or even begin a project. So tonight, we're going to talk about the navigation process of loans and lending without being sent to the poorhouse. I think this is a good topic, Holland.
Well, we need the help of experts, and we have two of them with us tonight. Let's welcome to the Afterword table Susan Stahl, the program director at Village Engage.
Hi, everybody.
Hey. And in addition, we are thrilled to have Kerri Smith here. She is the South Carolina president of Self-Help Credit Union. I just like the name of that organization myself. Welcome, Kerri.
Oh, I'm so excited to be here to chat with you about this important subject.
Hi, I'm Holland Webb.
Hi, I'm Amy Boland.
And you're listening to The Afterword, a conversation about the future of words.
Well, I know both of you have personal stories that lie behind your professional work. In just 60 seconds each, would you mind sharing the Cliff Notes version of your life and who you are? And we'll start with Susan.
Sure. And being a graduate of the University of North Carolina at Chapel Hill, I know all about Cliff Notes. So in 1998, after a 13-year banking career with SunTrust Banks in corporate lending, my husband and I moved from Atlanta back to his hometown of Greenville, South Carolina, to raise our two sons. And 5 years ago, I started an organization called Village Engage, which is part of Mill Village Ministries. And the goal of Village Engage is to help people of faith learn about issues of injustice and inequity in our community. We also provide pathways for people to engage in advocacy for social change. 2 years ago, I learned that we have lenders in our state that are making loans at interest rates of 200%, 300%. And many of the people who are falling prey to these loans are minorities, women, and the elderly. So I am now serving on the steering committee of a statewide coalition called the South Carolina Fair Lending Alliance. And our goal is to have legislation passed that will cap interest rates on all consumer loans in South Carolina at 36%.
I did not know what you were going to say after cap the interest rates on all loans, but that was quite a number. I'll be interested in learning more.
Yeah.
Okay, Kerri, what's your Cliff Notes life?
My Cliff Notes are, I came to financial services, actually began working in the credit union movement back in 1987. I started when I was 5. But I have worked in and with about 50 credit unions across the U.S. as well as in 6 different countries. And so I was very familiar with financial services and the need for access to affordable credit over these years of working with these credit unions. And I had done everything right. And I started my own business I consulted with credit unions around marketing and advertising, public relations work, and had, done everything. I had savings, I had retirement and all of those. And in 2006, I had a root canal done and ended up with an infection. And over the course of about 6 years, I had 13 surgeries and ended up having 2 pulmonary embolisms, and also even contemplated suicide because we could not find what was causing these infections. And I'll tell you that I used all of my retirement, all of my savings, and literally was at a point in my life where one of my medications, and we have great insurance. So this was outside of great insurance, which I was very fortunate to have. Having to spend out of pocket $1,500 for one medicine, and actually even considered utilizing more alternative lenders and started looking at what they were charging individuals and those terms and conditions. And so then it really made clear the work that I had done after all those years in credit unions and in all these countries and here in the US. And I just have made that my mission to find ways that I can help people avoid those pitfalls and get to a place where they can afford the credit and have access to affordable financial services. So I'm happy to say I'm glad I went through that, because if it can happen to me, we almost lost our home. My husband's vehicle was repossessed, but the reality and what I want people to know, and the people I work with every day, is that if it can happen to me, someone that did everything correct, and I'll put that in quotes, can end up at that place. It can happen to anyone, but you can also get yourself out. So I want people to have hope, and we want to give folks the tools to avoid those pitfalls.
Wow, Holland, this sounds so much better than a Dickens novel already. I think we're on the right track. But for many of our listeners, myself included, and I just think, again, when we're talking about some of these things, I'm already hearing words that need to be clarified. And I think part of the big fear of financial institutions is we don't understand the vocabulary. So we're going to do a lightning round. Either one of you can take the term, the word, just jump in, and both of you can talk about it, not at the same time. So here's our first one: predatory lending versus fair lending. And I have a feeling that Susan may jump on this first.
I am going to jump on this first. So first of all, I'm going to start with fair lenders. So fair lenders are organizations that make loans to people where they thoroughly evaluate the potential borrower's income and expenses to make sure that the borrower can afford to repay the loan and at the same time have plenty of money left over for their living expenses. So the lender's products are designed to be borrowed and repaid over a very specific period of time. And the goal is for the loan to be repaid under the terms it was made. In contrast, there are many other lenders where a person can walk into their shop off the street and they can walk out 30 minutes later with a loan. And these lenders are not doing the same level of what we would call due diligence of evaluating whether or not the person can actually repay the loan and afford their normal living expenses. So what they do is they charge really high interest of rates to cover their high rates of bad loans. the bad loans being people who can't pay their loans back. In addition, with predatory lenders, many of their loan products are actually really designed to lure people in and then to be renewed and extended over and over and over again when people cannot repay. So they are designed to create an unending cycle of debt.
Yeah. Okay. We're going to talk about that in a little bit too. I'm kind of thinking in my brain, when I went for my mortgage, I sat down with a mortgage officer and they looked at my income. They looked at so many things I had to give them in order for me to get the loan for my house so I wasn't house poor. Is that what you're talking about, being a fair lender?
Absolutely. They sat down, and one of the key things you said is they sat down with you, they partnered with you, they created a relationship with you, and they fully evaluated your income and expenses. Yes, that is what I would call a fair lender.
Okay. All right. So how about this one, payday lending? You kind of mentioned it, but maybe Kerri, maybe you guys have something else that you can jump in with.
Absolutely. Well, payday lending is defined as a loan that is given to someone that has to be repaid in full their next paid period. So,
yikes.
Yes. And that, and these payday loans generally work around, there's a fee to get the loan. So if they wanted to borrow $100, the fee may be $20 and they only receive $80. And then at their next payday, which might be next week, or it might be 2 weeks, or it could be if they're on Social Security once a month, then they have to pay that full amount back. And so what happens with payday lending, what we see that makes it predatory in nature is that people will go in and they can't afford to pay it off the next time. So they end up either, depending on the state that they live, they just get another loan. So they pay another $25, $30 and then get the difference that pays off the first loan. So there really is, it's the same $80 really is the proceeds over and over and over and over, costing you $20 or $30 each time, depending on, when they get paid. So payday lenders in the state of South Carolina, there is legislation and there is laws that say that there has to be a cooling off period. And what we found is these lenders, when a person cannot pay it off, to avoid those parameters of the law, they end up switching them and moving them into what they call an installment loan, which means that the term is not to be paid in full by the next pay period, but instead can be paid over 6 months, 12 months, 24 months, whatever that term is. So payday in South Carolina is what we refer to as the gateway drug to this debt trap. It's because it moves them into a longer term, high cost loan. And in this state, in this state, we see interest rates of 395%. The highest interest rate I have seen on an actual contract was 769%.
Good grief.
And then for title loans, this one is where an individual has their title to their car and they need some money. So they'll go into a title lender and give them the title to their car. And then the lender holds that car title as collateral for the loan. And generally, they only give about a third of the value of the vehicle. And then if they're late by a matter of days, a lot of times they're repossessed and taken. So, and those interest rates, I routinely have seen 146%, I've seen 216% several times with some of these lenders. And so that is another one where when they can't make the loan payment, they turn around and rewrite the loans. And of course, with every loan, there is fees associated.
Sure.
So those two types of loan programs or products can be very insidious.
Okay. Susan, do you have anything else to jump in on those?
No, not on those, but I would love to talk about rate caps.
That is our next term. How did you know?
I don't know.
Let's do it.
Let's do it. So, in order to protect consumers, what a lot of states are doing is they are enacting what we call all-inclusive rate caps. When we talk about an all-inclusive rate cap, it caps not only the interest rate, but it caps all the fees, whether it's insurance products, closing fees. It adds all those fees into the calculation of the APR, the annual percentage rate, and states are capping that at 36%. So even though 36% sounds high for a lot of people, when we're hearing about 200%, 300%, 600% interest rates, when you look at taking the interest rate and adding all fees in and capping it at 36%, it is a welcome relief. And so that's actually what we would like to do in South Carolina, is do an all-inclusive rate cap.
Okay, excellent. Kerri, anything else on that?
I think lending, we have to have access to credit as a society. And unless you have, some parameters and guardrails in place, then consumers have some protection. And with 36%, we know that people can pay those off and get out of the debt. So
Sure.
if they're soundly underwritten and debt to income is taken into consideration.
Okay. And this idea of rate caps, all inclusive, would that be, is there a move to make this universal across the nation, across other countries? Is this just something in South Carolina?
Susan, you want to take that one?
So I'll start with that. Sorry. So there has been legislation that was passed that protects our military. So when a lot of people talk about, well, why 36%? So there's federal legislation, and I can talk about this a little bit later, called the Federal Military Lending Act, that does this all-inclusive rate cap for active duty military. So we already have that in place, but we do not have protections for the rest of the population, for you, for me, for teachers, for firefighters, for first line people. But so in that gap, other states are on a state by state basis taking that Federal Military Lending Act and saying we want to extend that to the rest of the residents of our state. Okay, perfect. Well, thank you all so much. This is already such an educational experience, and I feel like I am starting to understand it. And also, it doesn't quite sound that dark. I feel like we can kind of dig ourselves out a little bit and as Kerri said, apply some hope.
That discussion helped me understand, because when you first said 36%, I thought, goodness, that seems high. But of course, as long as I have been dealing with borrowing money, interest rates have been pretty low for things like mortgages and student loans and even credit cards. And so 36% just seemed outlandish to me. But when you put it up against 700 and something percent, now I get it. Now I get it. What are some of the open doors and some of the barriers to credit that you see particularly over the last maybe 10 years here in South Carolina and then across the nation?
Well, Holland, I really have seen the barriers for individuals, especially our low wealth and people of color, have been pushed out, in some cases systemically, across our country. And some of that has to do with, one, a lot of institutions, traditional institutions, banks and credit unions, they deny banking services to people because of credit score, or some other factors. Maybe somebody had a checking account at one point and they had some trouble and they got reported to vendors like check systems that really create a real barrier to working with a traditional financial institution. But we also know in some communities, there's not a lot of trust of financial institutions. And so people have stayed out of that because they don't trust them, because they've been treated poorly. And so I think that some of the bigger barriers also are sometimes traditional financial institutions are not located in their communities. Right here in Greenville, we have pockets where there are no banks, there are no credit unions, and for folks, transportation is a challenge. So they can't get to a traditional lender. So I think those are barriers that when we're talking about, well, people just should do this or go to this institution, we need to be cognizant of the fact that not everyone has the same access as I do as a white female in this world.
And I've got a great story about an opening door. So it's in my hometown of Greenville, South Carolina. And there's this really wonderful congregation called St. Anthony Catholic Church. And the parishioners of this parish basically looked around the community where their church is situated, and they saw all kinds of people who needed access to funds, but who did not have access to funds. So a group of parishioners came together and they donated money to start a revolving loan fund, which they have called the Mica Fund. But one of the things they do, so they meet with prospective borrowers who they call neighbors, and the parishioners who are working with the Mica Fund, they partner with their neighbors and talk about budgeting and financial management. Again, we're talking about building that relationship. And self-help, actually, so we have people that have donated money to create a revolving loan fund from the congregation. The congregation members are actually meeting with their neighbors. And then Kerri's organization, Self-Help Credit Union, is making the loans and managing the fund. But the people in the parish are building the relationships. So one of the other really interesting sidebars as the Mica Fund has gotten established, as they have met with their neighbors, a large percentage of the people who are coming in saying they need a loan, when they talk through the issues that they're facing, a lot of times the people from the congregation have helped them find other solutions, whether it's a rent assistance program or a utility assistance program. So they are helping people actually stay out of debt as well.
Wow. I love the balance that you all gave of the barriers, but also the open doors. I think it's such a good thing to have those perspectives and just appreciate those stories behind understanding this very complex subject. Let's dive in a little bit more with complex subjects, though, because right now we're just hearing it on the news, the credit card debt that the average American, and I'm sure in other countries as well, is just skyrocketing. Typical credit card balance is over $5,000. And you were talking about revolving door lending. This is revolving door debt. So if you could please expand a little bit on some tools that you all use to assist in helping others in this revolving debt and loan, like credit cards. And Kerri, I'm going to start with you first.
Oh, thank you, Amy. This one is, first of all, let's talk about the importance of revolving credit to credit scores. It is our system in the United States. This is not necessarily true in other countries, but in the United States, our credit score is heavily weighted on revolving credit. So if you want a good credit score in the United States, you have to have some revolving credit. And it really does, how you manage that revolving credit has a huge impact on that score. And, in my mind, this system, because the credit score now doesn't only affect your credit, the ability to get credit, or your cost of credit, because your credit score is a driving force. Almost every lender that's federally regulated, whether it's a credit union or a bank, bases the pricing or the interest rate of your loan on your credit score. So revolving credit is almost a necessary evil in some ways, especially for folks that have a hard time managing revolving debt. And so when we're talking about it being, really hard and that maybe it's not the best thing, it is essential to have good credit and, a really good credit score. You need that revolving credit. So it creates an environment that can be a hazard for a lot of people, in our country. Susan?
Yeah, so I want to just tell you a really interesting story. Right at the beginning of COVID, I have 2 credit cards that I use. I have one that's a Wells Fargo card and one that is an American Airlines card. And when I went in to help co-sign for my son's car loan, I had this amazing credit score. And I had been using my American Airlines card that is solely in my name. Well, when COVID hit, I was like, wow, I don't necessarily know that I need traveling points, flight points. So I'm going to switch back to the Wells Fargo card. Well, the Wells Fargo card is in my husband's name. And so when I flipped using credit cards, and I'm the same person with the same financial resources, I saw my credit score drop over 100 points. And I was like, what is going on? And the reason my credit score dropped is I was not using the credit card that was in my name, even though I still had the available credit. So as Kerri's talking about, these credit scores it's a really interesting game based on, you could be not using your credit card as much because you're saving more, and yet the credit scoring is looking at how much you're depending on your credit cards. But one other point I wanted to make was that, so it does, a lot of times we feel like credit cards are the evil debt creator over here. But the Pew Institute has done pretty extensive research on the impact of predatory lending. And one of the things they've done is they have looked at what are other less expensive options for people than a payday loan, an auto title loan, or a high cost consumer installment loan. And so the things they've come up with are, number one, are there other options like another program like the people with the Mica Fund have seen that you might not need a loan at all? Or do you have friends or family you could borrow from? But one of the options is, do you have unused credit card that you could use? Because a lot of times a credit card debt is less expensive than going to one of these these predatory lenders.
Okay. All right. I'm tracking with you guys now, because it almost sounds like, especially with your case, Susan, you don't use your credit card, you're penalized. But then you also may be penalized if you pay your credit card off every month, because there is no revolving debt with that, right?
Well, actually, what the scoring system likes to see is that you charge something and then and you can pay it off. You just have to wait for the billing cycle. You get your statement. So we advise people all the time, especially low income borrowers or people that are trying to rebuild their credit, is to get a card and maybe put your Netflix on it and then have it automatically pay off when your statement is presented on your due date. And
Okay.
what that is showing activity on the card. Now, you don't have to pay it all the way off. The way the metrics works is that you need to utilize less than 1/3 of your credit limit. So if you have a $3,000 credit limit, do not charge over or have a balance over $1,000, and your score will be affected positively.
Okay.
So you can pay it off every month, but just wait until you get your credit card statement at the end of the billing cycle. Because if you pay it off before then, it doesn't count. It looks like you didn't use it at all. Okay.
So that is such a good tip, because again, we're looking for tools that help us to navigate this. So these two tips that's phenomenal. I think those are excellent to help us with this, getting our feet back underneath us. Thank you.
Interestingly enough, as we've been talking, an email popped up on my phone from Credit Karma. The subject line is, "Congrats, Holland. You have outstanding approval odds with Amex." And the first line of the email is, "Earn cash back at U.S. supermarkets and on select streaming subscriptions. You're going to need a bigger cart."
Wow.
Like they aren't pushing us to get these cards and charge on them.
Yeah, it sounds like you just won the lottery.
Right. That's what it sounds like, right? That's what it sounds like. Okay, let's look at this from the opposite perspective. I know when Amy and I were talking with Ivan Ants and Mike Scanlon a couple of weeks ago about money from a different perspective, we learned about bonds, which they explained in simple terms was a loan. So when you buy a bond, you are loaning money to someone else and you are getting paid back with interest. What are some best practices that we can know about before we buy bonds so that we know we're actually helping people and not causing harm?
So I'm going to talk about best practices, not for people buying bonds. I would leave that up to your investment advisor because I sure don't know a whole lot about buying bonds. But I would say for anyone who is looking, thinking that they need a loan, it's the same advice. We need to do our due diligence. We need to do our homework. And the good news is if you are somebody who does not have a financial advisor or a financial consultant, in my hometown of Greenville, South Carolina, and it's the same in most other communities, there are a lot of organizations that for free will help you with that advising. So in Greenville, somebody can go to United Ministries, they can go to Community Works. They have people who are financial advisors who can sit down with you and you can say, here is what my need is. This is my financial need. And they can help you figure out the best solution, whether it's a loan or whether it's not. And if it's a loan, making sure that you are not getting sucked into a loan where you don't fully understand all of the terms.
And I would just add to that, that I tell people and advise them, when you face a financial emergency or an urgency, to pause, take a moment, and don't react. There is a great book. It's called The Soul of Money by Lynn Twist. And it talks about our relationship as humans to money. And there's so much emotion that's tied into financial buying. And we know that people that are in a state of anxiety and fear around an issue, we don't think with our whole mind. I know that was my case when I was going through it because I'm sick and I can't find the answer. And there wasn't a lot of bandwidth for me and it felt real urgent. And it was at the moment when I took a pause and took a breath and then start really researching whether a loan is really the right solution to the issue. And so while the loan is fast and it's easy, the results are something that will affect your life ongoing and in most cases in a very detrimental way. So what I hope folks will do, and my biggest, the biggest suggestion that I have is to stop and really think about maybe how you can utilize a financial coach or counselor. We have great organizations in Greenville that provide that and can be some of that sounding board, free financial coaching and wellness. But don't try to tackle it necessarily on your own. And a lot of times that's what we do because there's a lot of shame wrapped up in money. And what I want people to know is that is not a reflection on you. Life happens. It happens to all of us. If it can happen to me, it can happen to anybody. So take that moment of pause and then find that person or organization to help walk you through.
Wow. I really hope that all of our listeners are really taking notes on this one, like replay, listen to this a couple times. It is so true. That connection to the emotional triggers that money can cause are some things that are just creating reactions. And, just like Holland, the email you got, what a great emotional pull. Hey, you're going to need a big cart.
Right.
Okay. This was excellent. So we want to continue our conversation, but I'd love it if you would each share an essential element, wrap it up, put it in a pretty bow, about loans and lending. Susan, I'm going to start with you first.
Yeah, so I actually want to do a really specific story. So as a former banker who was used to looking at financial statements, when I want to really understand the intent of an organization, a lender, I'm going to go to their annual report. And I had my mind blown when I read the annual report of a high cost lender that is headquartered in Greenville, South Carolina. And I went to the section in the annual report where they talked about their marketing expense. And they talked about, so a lot of times these lenders in public will say, oh, we're here to help people when they have a crisis. Well, in their annual report, it tells a different story. It tells that they spend the majority of their marketing budget during the season we are going through right now called back to school. And then during October, November, December, leading up to the holidays. So that is telling me the story that these lenders are marketing to people who want to do in their hearts. They want to do the best thing for their family. They want their kids to have the best school supplies and new clothes. They want to be able to give their family the best gifts, but they are also encouraging people to spend money they don't have. So I just have learned, I just seen a really interesting story told in the annual reports of some of the lenders headquartered in South Carolina.
Okay. So we got to do our research is what I'm hearing.
Yes.
Okay. Kerri, how about you? What's an essential element we need to hear?
Well, I think that one of the stories that really sticks out in my mind is an individual that I work with. She was a widow. She had lost her husband a couple of years before. She was on disability, and she had not been the one that handled their finances. And so she was faced with, an expense that she had not anticipated, and decided to go to a car title company to get this money. And she borrowed, it started out at $3,500, and she quickly could not afford the loan. Her disability payment every month was $863. And this car loan, they ended up doing it over, at first 36 months, and her payment was well over $500. She only got $862. So you can imagine when that payment came due, she didn't know what to do because she didn't want to lose her car. So what she did is she went into another of these predatory lenders and took out an installment loan, which was another $300 a month for 24 months. And of course, as you can imagine, when they came due the next time, she couldn't afford it. And so she ended up, in a situation she was going to lose her car. And she came to us, and we were able to refinance her out of that. But the stress that I saw in that woman's eyes was heartbreaking, because she couldn't afford the first loan. And then here she was. She ended up, by the time she got to us, she had 3 of these loans. So what I want people to know is, one, they're not alone. But the worst thing you can do, and a truism in this world, is you cannot borrow your way out of debt. I want people to take that pause and let's look for ways that we can solve your need without having to go down that road and end up in that kind of debt trap.
Wow, that is amazing. And I have a feeling that these predatory lenders don't like people like you, Kerri, and Susan outing this information, because I would imagine they benefit from the public, myself included, being ignorant of the tactics.
Oh, you're right about that.
All right. Well, we're going to have to keep this conversation going, Holland. We got too much to talk about.
We do. And so we'd like to say special thanks to Susan Stahl and Kerri Smith. I know I have learned a lot in this conversation. While you wait for part 2, please go to theafterwordpodcast.com and become a subscriber. You can leave us a review and be sure to tell your friends about us. And as always, remember that you are welcome at our table.